If there's one thing that sends chills through Wall Street, it's the eerie silence, strategic silence from the legends of finance. Not panic, not fear, not headlines about market crashes, just deliberate inaction. And right now, that's exactly what we're seeing from some of the greatest investors alive today in action. Warren Buffett, Howard Marks, Michael Burry, legends of investing and finance. They've made their fortunes by buying when others were afraid. But in 2025, something strange is happening in the market. They're waiting. Why? And more importantly, what should you be doing about this? Let's break it all down. Warren Buffett has built his entire career on one powerful principle: buy when others are fearful and sell when others are greedy. And yet, here we are. Fear is creeping back into the market. Uncertainty is rising. AI hype is soaring. Valuations are stretched thin across nearly every sector. And Buffett is currently sitting on an astonishing $334 billion in cash reserves. That's a record high. It's more than the GDP of entire countries, more than McDonald's, Netflix, or Nike. In the most recent 13F filings, Buffett didn't go on a buying spree. In fact, he didn't do much at all. Berkshire Hathaway made no major acquisitions and actually trimmed its stakes in a few key holdings, Bank of America down 14%, and a pause on buying more Apple shares. Even the much-hyped Buffett sells S&P 500 ETF story. It's overblown. VOO and SPY made up just 0.01% of his portfolio, basically a clerical footnote. So what does it mean? Buffett's not afraid of the market. He's not selling everything. He's just not buying right now, waiting for the right opportunity. And when the most legendary value investor in history is on pause, it means he's waiting for something much better. Buffett knows deals don't come when markets are euphoric. They come when fear hits peak levels, when prices drop and the world starts to doubt itself. That's when opportunities arise. That's when Buffett pounces. Just like he did with Coca-Cola back in the 1980s. Just like he did with Bank of America during the financial crisis of 2008. Just like he did with Apple when it was trading at a massive discount in the early 2000s. Right now, he's reloading his strategy, not retreating from the market. Howard Marks is often the least flashy of the great investors, but don't confuse that with a lack of action. Marks is a student of cycles. He founded Oaktree Capital, a firm built on deep value and risk management. And in 2025, he's sending a subtle but powerful message. Now is not the time to be too greedy. In his latest filings, Oaktree's portfolio shrunk by 16%, from $5.31 to $4.48 billion. That's not just a tweak, that's a real retreat. He trimmed 26 out of 56 positions, fully exited 7 stocks. His biggest exits, Alibaba, completely sold. All of this comes after a significant rebound in Chinese tech stocks, marking a notable recovery in the market. Why would he decide to sell after a recovery? Because that's when most people start piling in. Marks knows you don't ride the wave forever. Get in early and get out when the party gets loud. But here's the nuance. He didn't dump everything he had. He still holds Pinduoduo, NetEase, and Yum China. These are long-term plays focused on Chinese consumers and technology growth. This tells us something crucial. Marks isn't bearish, just disciplined. He's doing what most retail investors can't bring themselves to do. Locking in profits when things feel good. Waiting patiently until the next great bargain appears on the horizon. That's not fear. Michael Burry is a legend for one reason. He saw the 2008 financial crash before anyone else did. He bet against the entire housing market and won big money. Burry has stayed under the radar, until now. Recently he made headlines for going big on Chinese tech stocks like Alibaba, JD.com, Pinduoduo, Bilibili, and IQE. At the time, most people thought he was absolutely crazy. Chinese equities were beaten down by regulation, COVID-0 policies, and geopolitical risks. But Burry didn't care. He saw deep value in it. Now he's taking money off the table. Alibaba cut 25%, JD.com down 40%, holding Pinduoduo, Bilibili, and IQE, securing profits after rebound. Just like Marks, Burry isn't running away. He's rotating positions. Remember, this is a guy who acts fast. If Chinese tech dives again, don't be shocked if he buys more. Because Burry doesn't chase headlines. He chases true value. And right now, he's signaling that the value he once saw is no longer as attractive as before. So what exactly are these three investors seeing here? Here's the big picture. The S&P 500 is trading near its all-time highs. Price-to-earnings ratios are inflated. Retail participation has reached its highest level since 2021. AI stocks and speculative tech are driving most gains. And yet, corporate earnings haven't kept pace with expectations. Debt levels are climbing, consumer savings are falling, global risks from China to the Fed to geopolitics are mounting rapidly. The result, a market that appears strong on the surface but is actually full of hidden cracks beneath. Buffett, Marks and Burry aren't scared, they're just very experienced. They've seen this movie before. And they know the real money isn't made by chasing the top, it's made by anticipating the drop and acting decisively. Now let's talk about you. You're not managing billions of dollars, you're not Warren Buffett, but the same investment strategy still applies to you. Ask yourself, are you sitting on some cash for the next market correction? Are you trimming those overpriced positions? Are you thinking about value investing or just chasing momentum in the market? This isn't just about being bearish or predicting a market crash. It's about being prepared for